So hello, if you haven't been paying attention, the market's going a little bit crazy right now. So we'll try and sort of do a little deep dive for the next couple minutes into what might be causing the market to be doing what it is doing. Try and kind of be a little nerdy because that's just kind of where I land, but not so nerdy that you get lost. So do me a favor though. I get a lot of people when I bump into you letting me know that you like my videos. Please do me a favor. Click the like button so that just gives me feedback and lets me know that you've enjoyed it. And then we'll go ahead and we'll dive right in. Um, so yesterday the Nasdaq was down 4%. The S&P and the Dow were both down in the 2% range. So we had really a rough day. And it's important to understand and think a little bit about why this is happening, especially in light of recent changes in terms of policies. And having those different policies in office may make a big play in it. And it is a lot of policy driven, but it's also a lot having to do with the last few years. So, like I said, I'm kind of a nerd. So we're gonna pop on the screen a little bit of a sketch out some things for you, and it helps me to kind of help explain it to you. So hopefully this works, and hopefully you'll see what I'm wanting you to see. That is not it. We'll talk about that in maybe just a minute. I'm going to share my iPad with you so that we can kind of sketch a few things out for you. So, okay, let's go. So you should see my iPad screen now. Um, The thing I want you all to remember is when we talk about economics, there's one thing that means everything. So we talk about markets moving ups and downs and everything like that. It all boils down to this idea of supply and demand. And this is, if we draw it maybe a little bit better, when you really look at it, what you tend to see is you tend to see a supply curve and a demand curve. And what it basically tells us is this is the price axis and this is the supply axis. And where they meet is where things sell for. So if we'll say that right here is $3, that's how much as a producer you're willing to produce, and that's how much as a buyer you're willing to buy when the price is $3. This rule of supply and demand affects every aspect of economics. So if the supply changes and say we end up producing more, but the demand doesn't change, the new curve will make it red. The new curve is going to be out here. So the demand is the same, but now there's so much more, I have to sell it for less because now there's more and the people who have it don't want it. But if on the other hand, instead the supply goes down, we'll make this blue. If the supply goes down, then what happens? There's less of it. We have to sell it at a higher, we get to sell it at a higher price. So this law of supply and demand controls everything in regards to economics. And we can look at it the exact same way, but in terms of the demand chart. So now if the demand goes up, we can sell for a higher price. So think about it this way. I like to think of it. I've been talking to high schoolers about this, and I've been talking to them in terms of shoes because shoes are the big collectible thing. So we think about it in terms of the new LeBrons. If there's more people that want the new LeBrons, you can charge more for it. If there's less people that want them, you have to charge less for it because you're not going to make as much. Likewise, if Nike decides we're going to make more of them, they make more of them. They're easier to get a hold of. You can't charge quite as much. And if they make fewer of them, they're going to be able to charge more. So the goal as a business, or we're not going to talk so much in regards to businesses, we're going to talk more in regards to dollars. The goal as a business is to find this spot where we can sell the most units for the highest price, and it ends up making the most amount of profit. So now, how does this affect the stock market? Well, it affects the stock market because with the stock market, you have two different supply and demand curves going at all times. The first one is the value of the stocks, and the second one is the value of the dollars you're buying it with. So that supply and demand curve that I just showed you and everything that it has in it is also taking place not just in relation to stocks, but it's also taking place in relation to dollars. So as there are more dollars going into the market, or more dollars coming out of the market, the value of your dollar that you're holding actually changes. And it can change in drastic ways. So think about dollars in terms of collectibles. The more collectible shoes there are, the less each pair of shoes is worth. The more dollars in the market, the less it's worth. Now, when we talk about it in terms of shoes, it kind of makes sense because the price is dollar related. When we talk about dollars as having a fluctuating value, it doesn't make sense quite as much because we always think $1 is $1. But $1 isn't always $1 because and we understand this because a dollar of eggs last year bought more eggs than a dollar of eggs this year. So when we think about what that dollar can buy, that's where we find the value. So now let's look. I have another slide I'm going to pull up. And this slide will help you to really understand, I think, hopefully help you to understand what's going on. So let me pop this slide back up. And this is going to kind of show you what has been going on over the last few years. All right. So let's put it in the biggest mode. So if these are kind of, this picture here kind of represents all the main players in the US economy. If this box in the corner down here that I'm just circling now, if that's the economy, it can grow and it can shrink over time. Now, remember, we had that idea that more dollars in the system means that less people want the dollars. I want you to always think of it in terms of, and I'll kind of give you a picture over here, in terms of a teeter-totter. If the dollars are on one side and all the stuff is on the other, if the value of the dollar goes down, the value of the stuff goes up, right? Likewise, if the value of the dollar goes up, the value of the stuff goes down. Okay. We call this inflation. Inflation, which you've heard a lot of lately, inflation deals with when the value of the dollar goes down and the cost of goods goes up. So now if I want to go buy eggs, I'm paying $2, $3 for a dozen where I used to be paying $1.50. That's inflation. There's also a flip side of that. It's called deflation. Deflation is when the value of the dollar goes up. Because if the dollar becomes more valuable, the eggs are going to become less valuable in comparison. So when this whole bird flu thing is over and there are more eggs available, you're going to see we should see deflation in the egg price. We should see the price of eggs come down. So in relation to each other, dollars got more valuable, eggs got less valuable. All right. So if we look at the different players in the U.S. economy, we've got the Federal Reserve Bank up in the top right corner or top left corner. We've got Congress in the top right. We've got the economy, which is everything, all of us. The bond market, which is just where you can buy U.S. treasuries. The Treasury itself, who prints the money and actually manages the government's money. And we've got all the banks who lend out and hold money. Our economy over here for the last, really since 2020 throughout COVID, has been just exploding. We've been seeing a real appreciation or growth in the value of stuff, specifically investments. Homes have gotten more expensive. Stock market has seen almost a straight rise to the top all the way up for that whole time period. What that does is as the economy grows, the dollar actually becomes less valuable in comparison to houses, and in comparison to cars, and in comparison to stock prices, but also in comparison to food. And we see this inflation kick in. The Federal Reserve Bank up in this top right corner, or top left corner, I keep saying right, I'm sorry, top left corner, has a mandate. They are in place to do two things: 2% inflation and full employment. They want to make sure that inflation stays right around 2%. If it goes below 2%, they want to make it go faster. And if it goes above 2%, they want to make it slow down. And they want to average out to about 2% over the longer period of time. They want to do this while making sure people are employed. So the economy has what they call full employment, as many possible employees as you can have. There's always going to be some people unemployed because maybe they're changing jobs, or maybe they just lost a job and they're looking for a new one. There's always going to be those kind of things. So full employment is not 0% unemployment. For a while, it was 3%. Now we're at 4%. So it's where they think it's going to be is going to determine what they do. What the Federal Reserve has been trying to do for the last couple of years is they've been trying to slow down inflation. They've been trying to increase the value of our dollar and make sure that our dollar doesn't go down too much in value. And the way they do that is by increasing interest rates, so that when you go to the bank to take out a mortgage, the interest rate for the mortgage is higher. When you take out a credit card, the interest rate is higher. When you, as an investor, buy treasury bills from the government and invest in our government, the interest rate that you receive then will be higher instead of the one you pay. And they do this, they do this by going into the bond market. Oh, what did we lose? There we go. We'll pull that back. They do this by going into the bond market. The Fed's the one working, and they buy or sell bonds. So again, think of the teeter-totter. If they're buying bonds, what they're doing is they're driving up the demand and making the prices go up. If the price of bonds goes up, the interest rates of bonds goes down. If the price of bonds goes down, the interest rates for bonds goes up. Here's why. Sorry, I had to think for a second. Lost my train of thought. So the reason that interest rates go up when prices go down is you have to, as the price of the bond goes up, fewer people want it. So you have to start you start to offer a lower interest rate. Or I had it backwards. As the price is going up, it's going up because people want more of it. So the rate starts to go down. You don't have to offer it as much. So when the economy goes bad, people decide they're going to start buying bonds because it's the safe place to go. The government's going to pay you back. They may print a lot of money to do it, but they're going to pay you back. So the bonds become really popular and people start buying them. The prices go up. And because of that, if you're the government, you now don't have to offer as high of an interest rate. People want the security, they're buying your bonds. Likewise, if the economy is doing really well and I have $1,000, I can put my $1,000 in the stock market instead of getting 3% or 2% in a bond. I'm going to do that. Well, then bond prices will come down because people don't want them as much because they're going to the stock market instead. And that's going to drive interest rates up. And the interest rates are going to go up to try and encourage people to come buy bonds. It all deals with this idea of supply and demand. What do people want? So they're manipulating interest rates to get people to buy bonds, raising rates to buy bonds. Here's why. The way the economy works is as it grows, there's more money in the system. So we end up with more money. The Federal Reserve wants to decrease the supply of money, which will in turn cause the value of money to go up. So the way they do that is they buy bonds, they sell bonds, taking the money from the bond market to the Federal Reserve. Selling bonds on the market takes money out of the bond market and into the Federal Reserve, driving up interest rates. And as those interest rates go up, then what banks will do is the bank will say, well, I can either lend to you where there's a risk I won't get my money back, or I can just give it to the government. So now the bank says, I'm going to buy money from the government, buy bonds from the government instead of lending to you. Then you are giving your payments to the bank, and your deposits and your interest and all that is going to the bank. The bank is taking that money and they're giving it to the bond market. And the bond market is taking that money and buying treasury bonds, driving up the price of treasury bonds. Driving down the price of bonds because they're giving more money to the Federal Reserve and they're taking more bonds out. They're driving down the price of bonds, which is raising the interest rate. Because as bond prices go down, interest rates go up. And as bond prices go up, interest rates go down. So by selling more bonds into the system, they're essentially encouraging money to leave the system. That's what the Fed has been doing. Now let's think about Congress for a minute. Congress, on the other hand, is the one who tells the Treasury print money. It also tells the Treasury how to spend money. So I lost our slide we were looking at. So as Congress tells the Treasury to print and spend money, that money comes from the Treasury and goes out to banks and goes out to the economy. So we have the Federal Reserve doing the best they can to make money flow this way, to get out of the economy. And we had Congress passing bills like the Inflation Reduction Act, the IRA, which was not an Inflation Reduction Act at all, but actually stimulated inflation. So Congress says to the Treasury, print money, put it in the hands of the economy. So what did we have? What does all this mean? Let me turn my slides off because they're kind of getting in the way. I'm trying to find the best way to do slides. So what does this, at the end of the day, all mean? Well, what it means is we've been living for the last 4 years, 3 years really, with a government that has been printing money. The money supply was booming because of their printing, and a Federal Reserve Bank that was trying to take money out of the system, and they've been both going against each other. I often said if I were the Federal Reserve Bank, I'd have been really, really mad at the government for the last couple of years because they were doing everything backwards compared to what the government wants to do. So here we are. We're in this situation where government spending is skyrocketing. Our debt is higher than it's ever been before. Our economy has been booming because of all this money that it's been putting into the system. Inflation has been going up because of it also. And while inflation has slowed down, it's still over the 2% mandate. And then what happens? We start to hear some rumors that the Federal Reserve Bank, when they meet next week, is going to raise rates again. That there's a chance that there could be a rate raise. And that scares the market. That scares the market. Not only is there a chance that there could be an increase in rates, but we have a president who's threatening tariffs on every country, threatening the chance of a trade war. And that scares the market. So then we have the problem that we have these two big terrors going on. It's two big concerns. Then we have a third thing going on. We have this Doge thing, and we have jobs being lost. And remember, the Fed's mandate is not just inflation, but it's also unemployment. So we have Doge losing jobs. Now, there were more jobs made in our economy in the past month than Doge lost for us. So we still had a net positive in jobs. But nonetheless, that's taking money out of the system. We now have three major things going on: a potential rate increase, a potential trade war, and loss of jobs that are scaring the markets and making people afraid that we're going into a recession. So what is President Trump doing? Well, what President Trump is doing is he's trying to trim federal government so that we have a long-term positive, knowing that it's going to create probably a short-term negative. So we put ourselves in this situation where we're kind of in this situation. I don't know what we put ourselves in, and we're in this situation where the government is going to shrink its spending, which will slow down inflation, but it will also slow down economic growth. Tariffs, if they go into place, could slow down exports. If we get tariffs placed against us, it could raise the cost of goods. Tariffs tend to be inflationary. And we have a Federal Reserve Bank that is threatening to potentially raise rates. So we have these three headwinds against us. But I want you to understand a really important thing. And the most important thing that I want you to understand is even in market timing situations like this, where it looks like the market is going to go down, we still don't know what's going to happen. Because we have a really big thing going on next week in the Fed Reserve. And if the Federal Reserve Bank comes out and they says, we saw what happened in the stock market, we see what's happening in the jobs market, and we're going to lower rates, that could change everything. That could be enough to really change everything. Here's another thing that could change. One of the things that we've seen Trump do over this first, what are we, 2 months now in office, is we've seen him say, I'm going to tariff you unless you do this. And then the other country does what he wants and he waives the tariffs. We saw this in regards to the plane full of immigrants that got sent back to Colombia, I believe it was. He said, fine, you don't take them back, we're going to put tariffs on you. And Colombia said, okay, I'll send you my plane. So what's another, the first thing is the Fed could choose not to raise rates. They could choose to hold rates where they're at, which would be okay, or they could choose to lower rates. The second big thing that could happen would be tariffs don't happen. He gets what he wants and we don't get tariffs. The third thing that could happen is we continue to cut in DOGE and we continue to lose employees in the federal government, which all in all, it is a long run good thing. We're spending too much money at the federal level to be healthy for an extended period of time. We're just disguising our financial struggles by inflating money, and government spending is one of the main ways we're doing it. So that's not going to change. But the third thing that could change is the tax cuts. He has been pushing, and he's really pushing Congress hard for tax cuts. And those tax cuts will be stimulatory to the economy. They will help the economy because they will put money in the hands of everyday people who are going to spend it. So tariffs, we think those tariffs may raise costs. The tax cuts will offset those. So the concern is, and this is something that President Trump has been talking about, the concern is tariffs without tax cuts would hurt. Tariffs with the tax cuts will help to save the economy. In fact, he even came out and has said multiple times in his State of the Union speech, which wasn't a State of the Union, it was an address to Congress, but nonetheless, he actually said it's going to be painful for a little bit, but we're going to get over it. So the likelihood is that we'll see a slowdown, maybe not a full reversal, maybe not a full recession, but we're going to see at least a slowdown of growth over the coming months while this all works itself out. But if we start seeing interest rate cuts, and we start seeing the tariffs going away, and we start see a cut in taxes, or at least a renewal of the Tax Cuts and Jobs Act that is going to expire at the end of the year, leading to a big tax raise. If we at least see a renewal of that, then we'll be in a situation where those positives could flip the negatives. And that leads to the question of, okay, well, what do I do? I've gone longer than I wanted to go. I did not want to, we're at 22 minutes. I didn't want to go this long. Well, you shouldn't really do anything, because you're not investing to use all of your money this year, and you're not investing to use all of your money next year. You are investing to use your money over the next 20, 30, 40, 50 years. And what that means is, if the things Trump wants to do the things he wants them to do, long-term economic probability of our country doing better is really high. We need to get our economic ducks in a row. You and I can't overspend. The government can't. We have to get that fixed. So in the long run, you really don't want to do anything. In the short run, there's too many risks to really go in and say, all right, I'm getting out of the market. Because after COVID, everyone that was afraid got out of the market. And look at what we've seen happen since 2020. You missed out on so much. The opportunity cost is too high. So generally speaking, if you have a good long-term plan in place, you really don't want to move. You really don't want to change it. You really want to keep things the way they are and just ride out the bad economy. So when you see the news say things like 4% down on one day for the NASDAQ, I want you to recognize you didn't have all of your money tied up in the NASDAQ. You had some of your money in it, some of it in the S&P, some of it in some Dow Jones stocks, and you probably had some bonds. So a drop in the market is not going to end things for you. I hope you followed all that. I know it's a little on the technical side and a little on the nerdy side. Not as nerdy as I could get, but I hope that helps you understand a little bit about what's been going on the last couple of days. It's basically fear of a combination of both inflationary things going on at the same time as deflationary things. And if the Fed does indeed start raising rates, whenever we raise rates, we see the market pull back. That's just is what it is. That's what it's going to be. So I hope that helps. Don't do anything stupid. Stay calm. Regardless of which side of the aisle you're on politically, we've been here before and we'll be here again.